I want you to imagine something that has never happened in your lifetime. Imagine the United States government holds a Treasury auction and not enough buyers show up. Not enough buyers for American debt. The government that has borrowed freely for 50 years, suddenly finding the market thinner than it has ever been. That scenario, which has lived in the theoretical for decades, is becoming measurably less theoretical with every passing quarter. And if you are 55, 60, or 65 years old, if you have a pension, a 401k, a savings account, a fixed income position of any kind, what happens in the Treasury market over the next decade is the single most important financial story of your life. I'm the Stack Guy. This is episode 3 of the Petrodollar Collapse Series, the Treasury market time bomb, what happens when the recycling stops. Before we go anywhere, I want to acknowledge something. This episode is going to make some of you uncomfortable. Not because the information is alarming, but because the Treasury market is where most of you have stored your financial safety for your entire adult life. I'm not telling you the Treasury market is going to collapse. I am telling you it is experiencing structural stress it has not experienced in the modern era, and you deserve to understand exactly why. To understand the Treasury market time bomb, you first need to understand the recycling loop. And I mean really understand it, not the textbook version, the version that explains why the past 50 years happened the way they did. In episode 1, I explained what the petrodollar recycling loop is. Here's the summary version for anyone joining us here. Oil is sold in dollars. Countries accumulate dollars. Those dollars go into US Treasury bonds. Treasury bond demand stays high. Interest rates stay manageable. The US borrows cheaply, forever. This loop has functioned with interruptions, but functionally since 1974. For 50 years, it has allowed the United States to borrow at rates that would have been impossible without it. But here's what nobody tells you about the recycling loop. It only works when enough countries need enough dollars badly enough that they willingly park those dollars in US Treasuries at whatever yield America is offering. And what happens when countries start needing fewer dollars? When the bilateral currency agreements we discussed in episode 2 mean fewer dollars accumulate in foreign reserves? Well, the answer, and this is the part that keeps Treasury market analysts up at night, is that fewer accumulated dollars means fewer dollars seeking a home in US Treasuries. I want you to feel the scale of what we're talking about. The US government currently runs a deficit of over $1 trillion per year. It finances that deficit by issuing Treasury bonds. $1 trillion every year in new bonds that need new buyers. For the past 50 years, the petrodollar recycling loop meant foreign central banks were always reliable buyers of a large portion of that issuance. Their demand helped keep yields low and borrowing costs manageable. Now measure what is actually changing. Foreign holdings of US Treasuries as a percentage of total outstanding debt have been declining. In 2013, foreign governments and central banks held approximately 34% of all outstanding US Treasury debt. By 2023, that share had declined to approximately 23%. That 11 percentage point decline represents trillions of dollars in Treasury demand that foreign central banks are no longer providing. If foreign buyers are providing a shrinking share of the demand someone else has to buy those bonds, and that someone else is either domestic buyers or the Federal Reserve itself. When the Federal Reserve buys Treasury bonds, which it did at extraordinary scale during COVID, it is essentially the government buying its own debt. And the consequence of that is inflation. Between 2020 and 2022, the Federal Reserve's balance sheet expanded from approximately $4 trillion to nearly $9 trillion almost entirely through Treasury bond purchases. Then came the inflation of 2021 through 2023. You felt that inflation. I felt it. Every American who shops for groceries, fills their gas tank, pays their electric bill felt it. That wasn't an accident. That was the consequence of monetizing government debt at extraordinary scale. Now, here's the scenario that Treasury analysts are quietly running and that the financial media is not yet discussing clearly with retail investors. What happens to US interest rates if foreign Treasury demand continues to decline and the Fed cannot expand its balance sheet without reigniting inflation? The answer is rates would need to rise to attract buyers. Higher rates mean higher borrowing costs for the US government. And with $34 trillion in outstanding debt, even a 1% increase in average borrowing costs represents $340 billion in additional annual interest expense. To put that in human terms, $340 billion is more than the entire annual budget of the US Department of Defense in some years, generated by a single percentage point rise in average borrowing costs. This is not theoretical. Average US Treasury yields have already risen dramatically from their 2020-2021 lows. The average cost of US government borrowing is actively resetting higher as old low-rate bonds mature and are replaced with new higher-rate bonds. And here's what makes this specifically dangerous for people in their 50s and 60s. The conventional wisdom that bonds are the safe, stable portion of your retirement portfolio was built on 50 years of petrodollar-supported low interest rates. When interest rates rise, existing bond prices fall. That is not opinion. That is mathematics. If you hold a 10-year Treasury bond yielding 2% and rates rise to 5%, the market value of your bond falls approximately 25%. Between 2022 and 2023, the Bloomberg U.S. Aggregate Bond Index, the benchmark for U.S. bond performance, experienced its worst 2-year return in modern history. Worse than 2008, worse than any period most financial advisors have planned for. And most financial advisors, most retirement planning models, most pension assumptions did not account for this environment because they were calibrated on 50 years of petrodollar-supported bond market stability. I want to be precise about what I am and am not claiming here. I'm not claiming U.S. Treasury bonds will collapse. I'm not claiming the U.S. government will default. The United States can always print dollars to service dollar-denominated debt. What I am claiming is this: the petrodollar recycling loop that suppressed U.S. borrowing costs for 50 years is structurally weakening. And as it weakens, the cost of American government debt rises. And as that cost rises, every other interest rate in the American economy rises with it. Your mortgage rate is tied to Treasury yields. Your savings account rate is tied to Treasury yields. Your pension's actuarial assumptions are tied to Treasury yields. The Treasury market is not an abstract institutional concern. It is the floor under your financial life. Now, what does this have to do with silver specifically? Silver, like all hard assets, has historically performed well in environments where real interest rates are negative or declining. Real interest rates are the return on Treasury bonds after subtracting inflation. If the Treasury pays 4%, but inflation is 5%, your real return is negative 1%. You are losing purchasing power while technically earning interest. In a negative real rate environment, when the money in your bank account and your Treasury bonds is losing purchasing power faster than it is earning yield historically, people and institutions move toward assets that cannot be inflated. Gold moves first. It always has in monetary stress environments. Gold is the oldest monetary metal. It is held by central banks, and it has the deepest institutional understanding. But silver follows, and silver follows with more volatility, more percentage upside, and because of its dual industrial and monetary nature, a different and potentially more compelling structural case. The gold to silver ratio tells this story in a single number. Historically, when gold surges in monetary stress environments, the ratio compresses silver outperforms gold on a percentage basis. And the current ratio, sitting between 80 and 90 to 1, is at the elevated end of its historical range, which historically means silver is priced as if monetary stress does not exist at precisely the moment when structural evidence suggests it does. Now, I want to walk you through what the Treasury market stress scenario actually looks like for a silver investor in their 50s, step by step. Step 1. The recycling loop continues to thin. Foreign Treasury demand continues its measured decline. The US Treasury must increasingly rely on domestic buyers and Federal Reserve accommodation. Step 2. Treasury yields rise to attract buyers. As foreign demand thins, the yield on new Treasury issuance must rise to attract sufficient domestic and international buying. This is already happening. Step 3. Rising Treasury yields feed into all borrowing costs: mortgages, auto loans, corporate debt, credit cards. The Treasury yield is the anchor of all American interest rates. Step 4. Inflation remains structurally elevated. If the Fed accommodates Treasury financing with money creation, inflation stays elevated. Real returns on savings and bonds remain negative or near zero. Step 5. Hard assets receive a structural bid. In this environment, rising nominal rates, elevated inflation, negative real returns on paper assets, gold and silver historically receive sustained monetary demand. These 5 steps do not need to happen all at once. They do not need to follow a crisis event. They are the slow grinding consequence of a structural shift that began when the petrodollar recycling loop started to thin. Now I want to spend a moment on something that almost no financial commentator addresses when they talk about this scenario. The scenario I've just described is not catastrophic for everyone. It is catastrophic for people who are not positioned for it, and it is potentially quite good for people who are. If you are 55 years old and your entire financial picture is Treasury bonds and bond-heavy retirement funds, this episode is a prompt to have a conversation with a financial advisor about whether your allocation still makes sense in a structurally different interest rate environment. I'm not a financial advisor. I do not know your specific situation. What I can tell you is the structural case for holding some portion of your savings in assets that are not Treasury bonds or dollar-denominated paper is more compelling right now than it has been at any point in the past 2 decades. Silver specifically, at its current gold to silver ratio of 80 to 90.1. With its industrial demand tailwinds, with its historical pattern of following gold in monetary stress environments, represents what I consider the most asymmetric value proposition in the hard asset space. Let me say precisely what I mean by asymmetric. Asymmetric means the potential upside in a scenario where the structural forces I've described play out is significantly larger than the potential downside in a scenario where they don't. If the Treasury stress scenario plays out over the next decade and the structural forces I've described continue to develop, the gold to silver ratio compression historically implies silver outperforming gold by significant multiples. If the scenario does not play out, if foreign Treasury demand stabilizes, if the Fed successfully navigates inflation and rates, if the petrodollar recycling loop holds, then the downside for silver is its current price premium over its industrial value floor. That asymmetry significant upside, if the structural thesis develops, bounded downside supported by industrial demand, is the core of the silver investment framework this channel is built around. Now the accountability scorecard, episode 3 update. All 5 metrics, no cherry picking. Metric $1, share of global Forex reserves, 58 to 59%. The declining trend from 71% in 1999 continues. No single quarter reversal, a persistent multi-decade slope. Metric 2, UN settled oil trade volume, below 5% threshold. Growing but not at signal level. I'm watching for a sustained quarter above 5% that changes the assessment. Metric 3, central bank gold purchases, remains above 300 tons per quarter. Czechia and Singapore added to the most active buyer list this period. This metric continues at signal level. Metric 4, gold to silver ratio, 80 and 90.1 range. No compression. Silver has not received the monetary bid that gold has received. The ratio remains at historically elevated and therefore potentially opportunistic levels. Metric 5, US Treasury auction demand, bid to cover ratio shows continued mild softening, not yet at signal threshold. But the direction of this metric has not reversed in 3 consecutive episodes of monitoring. Summary for episode 3, metric 3 at signal level. Metric 5 showing consistent directional concern. Metrics 1, 2, 4 in monitoring territory. The structural picture is developing, not converging. Before you go, I want to do something I've never done in this series yet. I want to share a specific comment from episode 2 that changed how I'm thinking about episode 4. A viewer who goes by the viewer name, wrote in the comments of episode 2, "You keep saying gold leads and silver follows, but what if this time the industrial demand for silver is so strong that silver doesn't need to wait for gold? What if silver leads?" That is a genuinely excellent question. And it is going to be the central question of episode 4, which I'm calling Gold's Breakout and Silver's Lag, the historical pattern, and whether it holds this time. Here is what I want from you in the comments of this episode. Tell me about your own experience with the bond market over the past 3 years. Did your bonds perform the way your financial advisor told you they would between 2022 and 2023? Yes or no, and tell me what happened. I read every comment. And your experience matters to how I construct the narrative of this series. If this series is useful, subscribe. Episode 4 drops in X days, and it directly addresses the viewer question that has been asked more than any other in this series. Is silver's underperformance relative to gold a temporary lag or a structural problem? And one final thing, I want to say something directly to the viewer who is watching this and feeling something they didn't expect to feel, a kind of low-grade financial anxiety they can't quite name. That anxiety, that feeling that something has shifted in the financial system and you can't quite put your finger on it, is not irrational. It is pattern recognition. It is 50 years of financial experience telling you that something in the structure has changed. This series is built for you, not for the young investor who has never seen a bear market, not for the academic who watches from a distance, for the person who has built something real over 30 years and wants to understand the structural forces acting on it. You have earned the right to understand the real structural story, not the reassuring version, the accurate version. I'm the Stack Guy, Stack Smart, Stack with Data, episode 4 in upcoming days.